So with that, we're joined by Vuyo Mpako, Managing Director of NEXT176. If you don't know NEXT176, it's Old Mutual's corporate venture capital arm. He's not only leading the investment in Africa through this particular vehicle, I think personally he's helping to redefine how large traditional institutions like Old Mutual can partner with disruptors. I'd also like to say I think it's incredibly important that we encourage more companies to set up corporate venture capital arms, and we'll go into the reasons for that as well. We're going to unpack Vuyo's journey from a banking and telecoms background, how he's gone through his innovation journey, how he's ended up in this position, how he's really incubated this idea and taken it through to where it is now, warts and all, what's worked, what hasn't worked, and what others can learn from his particular journey. So whether you're an entrepreneur, a corporate exec, or just curious about Africa's investment landscape, you're definitely in the right place. I'll let you be the judges of that. For now, though, Vuyo, a very warm welcome.
Colin, thank you very much. I'm so delighted that we actually finally do have the opportunity to do this. Thank you, Colin.
Yeah, it's about time. It's about time. Now, let's see if I can get the questions out better than the intro. Let's just start off today. Can you just give me a little overview of exactly what NEXT176, what its purpose is, what it's actually trying to do, so that we've got context for the rest of the conversation?
Thanks, Colin. Interestingly, in the next month or so, it will be 4 years in the journey of NEXT176. So NEXT176 we started 4 years or so ago, and at that time, Old Mutual was 176 years old. It's 180 now. Just for the avoidance of doubt, I haven't been there for all that time. And 4 years ago, when we started NEXT176, the then CEO, Ian Williamson, had just started like a year earlier as CEO in 2020, and he could see that Old Mutual had really good growth prospects in our core businesses of today. But I think the challenge that he'd put to himself, to the board, and when we set up NEXT176 to me to lead was help us find growth prospects outside of the core businesses of today. Help us figure out what sits on the edge of the core businesses and whether there's optionality for us to kind of use those opportunities to grow and build businesses for Old Mutual of the future. But if not, they help us give a really great return and give us back capital with a decent return. So that's substantially what NEXT176 has been. And as you can tell, that the name NEXT176 emerged from kind of, hey, we're trying to figure out the next 176 years for Old Mutual.
There's an incredible range that you actually cover at NEXT176, from incubating ideas which sit within Old Mutual to partnering with other organizations. Hopefully you'll be able to talk about some of those really interesting ones you're doing. I'm not sure what's confidential and what's not, to acquiring other companies, acqui-hiring. There is such a large amount. Can you just give us some indication about how you kind of break it up into these different themes? Because obviously you then got to structure your teams in the similar sort of vein as well.
Absolutely. I think it's important for us to, how we've kind of structured what we do came out of actually how we saw the world, where those opportunities for growth would be. We spent a lot of time figuring out what that could look like. And we kind of said, listen, the best thing to do is to actually just follow where your consumers are spending money, where they're spending money today, where the opportunities for growth are going to be. But also in those areas where we foresaw that there would be growth going forward, are there unsolved problems? And that for us was an indication that someone is going to try to do something around that. Not all the opportunities that we saw as big and massive and had problems, and Old Mutual had a right to win in. But we did say, if we don't have a right to win in, as an example, infrastructure for telcos, as an example, I think it's a massive opportunity space. Retail is a massive opportunity space. The capital required for anyone to play in there is massive. So there is an opportunity for us to partner to embed financial services. But there were opportunity sets that we kind of thought we could play with in a very capital light manner by trying to build ventures in that space or trying to invest very early stage, with startups and entrepreneurs that we're building. So education was one of those, healthcare was one of those, the ecosystem around jobs holistically was one of those. So when you think about where we play, we partner where it doesn't make sense for us to invest in the infrastructure. And in places where we think we can create strategic optionality by investing early on, we either build or we do investments.
Okay, I see Next176 as being quite unique in Africa. I don't believe there are too many similar structures. I'd certainly say if there's more than 10 or 15, I'd be quite surprised. Is that your take as well? Do you see this as a rather unique structure?
I think so. I think so, Colin, and regrettably so, by the way, because I think we need more and we need more to be very, very successful. So I think it's kind of unique, and most of them don't last long. You know those stories. They don't last long, and so I think the opportunity for many of them kind of to operate and be successful is actually more important than it is just for Old Mutual. I think it's important for the entire ecosystem on the African continent.
All right, so that's where you are now. And just the last question, because then I want to go and see how you got here. Roughly how many ventures are you overseeing at the moment? What sort of facts and stats can you tell us to give us a bit of context?
So over the last 4 years, maybe 3.5 years, in fact, we have a portfolio now of around 18 odd businesses. Some of them we incubated in the venture studio and have carved out and graduated and have gotten co-investors. 3 or 4 of them are still in the venture studio. The rest are kind of equity investments. Over the last year, in the last 5 months or so, we've actually had one exit where one of the companies that we had in our portfolio, we actually spun it back into Old Mutual. There's 2 or 3 other transactions currently in flight where we're actually getting co-investors and we may exit.
Okay. Now, how did you get into this? Because this is a it's a unique role. I mean, you had a corporate background, beforehand, and here you are overseeing an entity which is tasked with literally investing in things that we don't know if they're going to work, you know, with capital, at risk, in partnership with many different entities across lots of different industries, and all against the backdrop of sitting there. I don't want to say fighting with the mothership, but potentially fighting, certainly having to manage a rather stable institution like any large institution. And that also creates its own friction points and its own issues. Maybe we'll tap into that. How did you get into this role?
I started, I think, Colin, if I kind of think about it over the last 25 plus years, I've actually been a builder in different settings. Um, so I started off my career as an engineer when I was much younger and smarter in telcos, and I kind of grew up in that world. My last role in telecoms was actually a managing executive at Vodacom. I got into financial services after business school. So I started Standard Bank around 2008 or so, ran ATMs and then got into self-service channels and which became digital banking, So before digital banking, there were self-service channels. And so built quite a lot of the Standard Bank's digital propositions over a 10-year odd period. And spent a lot of time also kind of having really great opportunities to kind of play in. I don't think it had the name venture building then, but we kind of were working with startups in the mid 2010s, 2013, 2014, kind of in the payments and the payments innovation space specifically. And that kind of led to me joining Old Mutual just under 8 years or so ago, firstly as Chief Digital and Data Officer, and then having the opportunity to not be building myself, but to actually be partnering with entrepreneurs that are building.
Okay. When they approached you to go and do this, were you a bit nervous? Because it is different.
I mean, the backstory is, I think I personally knew that we have to have a play in the space as Old Mutual. And so naively and stupidly, I kind of took the role on with, great enthusiasm and excitement. Yeah.
Okay. So you went in it eyes wide shut, right? Just thinking to yourself, this
Absolutely.
sounds
And I jumped in with everything that I had.
okay. But I'm assuming that there were some backers there that gave you some faith and confidence because for these to work, and the reason why many fail is obviously they lose support at the board and the executive level. You must have had great backing which encouraged you to go and take the plunge here.
Yeah, absolutely. I don't think, Colin, this was not me. I was asked to run to kind of build the platform up. I didn't. build it up on my own. And I think kind of CEO, board, exco support over the last 4 years have been absolutely top class. And in fact, I would further argue, if someone was asking about setting something like this up, if you don't have that exco and the board support, you're going to fail. It's just a matter of time.
Look, the board might be interested. I see on the catchphrase on the right or left-hand side, depending on the mirroring, it says you want to positively impact 1 billion lives. But boards only do these types of ventures because they think they're going to make money and they're going to increase share capital. What's the principal argument about why corporate venturing can actually do that, in your opinion?
Yeah, I think firstly, Colin, we have to put it out there that um, if you're not returning top quartile returns, you're out. Whatever you look at it, however way you look at it, all those fancy words mean nothing if you're not kind of returning, or promising to return money to your shareholders. I think that's fundamental. I think that's actually the most strategic thing you can do is to actually make money, or at least show that you're on the right trajectory towards making money. I think many of these fail because it becomes so strategic and you lose money and you think that someone in your organization likes what you're doing whilst you're losing money, and they fail. So that's really the fundamental. I also believe that specifically on the African continent, financial returns and societal impact are actually integrally interwoven. I've had many people ask us, you're focusing on education, you're focusing on health, you're focusing on jobs. Are you an impact fund? No, we're not. But we really believe that those key ecosystems where there's massive issues to solve, whoever solves them is going to create access to new types of clients and distribution. And that creates a massive opportunity for a financial services organization.
There's a couple of questions coming in, and now's probably the right time asking about where you're actually playing here. There's so much choice. I mean, you've got the theme about improving 1 billion lives. There's an obvious requirement from Old Mutual, I'd imagine, that some of the investments have got to be perceived as potentially benefiting Old Mutual directly, new products, new services which they can distribute, or maybe more distribution channels which they can send existing products through. But we're also in a point where there is so much change. There is so much happening in terms of tech and the advancement, particularly with things like AI and blockchain. How do you decide where to invest and where to partner? Because there must be thousands of people knocking on your door every single day.
Yeah, absolutely, Colin. I think one of the things that we did, and we continuously talk about this in our own team, is there's frameworks that are out there, but really being clear about which horizon you're playing in. We've got massive businesses, 30,000 people, at Old Mutual, across 12 different markets. It is critical that there's quite a lot of innovation that happens in those businesses today. Yeah. And most of it is focused on existing clients, kind of getting operational efficiency, driving additional revenue, and all of those things. So that's critical. We don't play in that space. Yeah, existing businesses play. We see a lot to help inform some of that, but that's not what we do. Where we said is the biggest problem and opportunity that exists in financial services, we believed, was in actually solving issues around distribution. So the ecosystems we came up with, whether it's education, health, jobs, was opportunities for us to find new clients, okay, and think about what financial services could look like in those realms. So starting off and being clear what problem you're trying to solve is super, super important, because there is so many things you can do, and actually not all of them are right for your unit. And so you see this quite a lot, it's like, where do you play? Are you playing in kind of solving problems for today's businesses? Are you playing in kind of the edge of that? Are you playing in slightly different horizons? And we deliberately said, actually, in our mandate, these are the key ecosystems we want to play in. This is the reason we want to play in them. But we will see a lot, and we continue to see a lot that we work with the different businesses in the group on actually funneling them through. So I'll leave it there, Colin.
When you talk, I mean, just following, they've got two questions here, Nadeem and Alan's. I mean, they're asking in different ways. Are you interested in online platform and marketplace type spaces? Is it blockchain, content aggregation, Or is actually none of those? You kind of focus on underlying problems and sectors and then worry about the technology and the kind of
Really the underlying, absolutely, so if I kind of told you all the other tech that is enabling this, it is given that the scalar here is technology. So it is given that it's the scalar here is technology. And so that's a key part of, what we look for in those specific ecosystems. But to be thinking about how much blockchain, this and AI, it's embedded in our world.
what sort of decision criteria do you have? I mean, if I think about, let's say, a Y Combinator, or pretty much any Silicon Valley VC fund nowadays, time and again they're always going to come back and they're saying they're looking for two things. One is they believe that the idea or the product is super scalable. They imagine it being accessible for hundreds of millions of people, and they want these network effects that go with it. That's where they see real opportunity for real value. And pretty much second, or maybe it's even first, they back the jockey. They're looking for people who running these, who are coming up with these ideas, who they inherently trust, with whatever bias that entails in terms of trusting these guys. But they're two key factors. There are others. What do you sort of look for when the guys are knocking down on the door and coming and saying they want to partner with you guys?
It's a jockey. It's more the jockey than it is a horse. It's more the jockey than it is the horse for us. And we've got data to prove that. We've got data to prove that. Remember, we also do venture building. And when we haven't backed the right jockey in it, it doesn't go well. But where we have backed the right jockey, the returns that you see are absolutely amazing. Yeah. We're lucky in that we've also created very, very tight themes in a way, so we're not looking for everything else that could scale. We're very, very clear on the things that we're looking for, and we're saying, is this the opportunity, to get into the gig worker space? Is this the opportunity to get into the millions of South Africans who actually are not getting good quality education? Is this the opportunity for us to kind of get into a platform that is scaling telehealth, telemedicine right across the continent? But more than anything else, it's not the business or the idea, it's actually the jockey. At this stage, it's really the jockey.
How do you do that? I mean, I know that if anyone on the call is sitting in a corporate environment or has ever had any sort of job at all with a reasonable number of people, there's been a huge amount of focus over the last decades about how to go and pick and employ people. Some work, some won't, some don't. Do interviews help? Do they not? Is psychometric testing important? How important is track record? 1,001 discussions, and still, I think, limited evidence in a lot of cases about whether those kind of metrics you apply actually really do work. How do you compare if I'd have done this versus that? You can't really A/B test employment in a short period of time. How do you go and get comfortable that your process for picking the right jockeys is actually working?
I mean, I talk to many people, even in our own organization, and there's many people who will tell me, listen, can I come and help with this venture and that venture? I'm so entrepreneurial. When I was young, I used to do the till for my parents, this and that. And one of the fundamental questions that we ask the people interested is, you know, how many times have you been able to go without a salary? Can you go without a salary? Let alone the bonus. Are you willing to let go of that? Are you willing to let go of the packs that you have right now? And then you kind of get then you're out.
I'm just wondering, I'm just thinking how many people that come to you that actually are willing to do this.
Then it's a then there's no conversation afterwards. I've had this many a times.
Yeah.
And actually, where we've had great successes is when people are worried that month end is coming, and actually they're not sure if when the payroll runs, they'll be able to pay themselves and the people in their team.
Interesting. Okay, so you've got the jockey, you've got the idea. Now you're quite interested in it. Then you do the second level analysis to think about whether there's an opportunity there. Are these kind of, 2, 3 day exercises? Is it a 4 month exercise to go and do deep research? How do you actually get now comfortable that A, there's a possibility, and B, it's something that Old Mutual accepts, it's not competitive against what they're doing?
Yeah, so I mean, maybe one or two steps back to just before we go into that level of detail. One of the things we said when we started off, Colin, is yes, we are corporate backed by an Old Mutual. That is amazing. It gives us so many other benefits. that, many other first-time VC kind of funds, they don't have that, So I didn't go and raise capital. I raised with Old Mutual. Yeah. So I don't have many of those challenges around capital raising. However, we've been very, very, very clear that our ability to deploy the capital that we've gotten from the group has to work in the context of the rules of the game of the ecosystem. Yeah. So if we are going to be playing in this space, we're going to be playing with other players who have led some of the transactions we follow on. We've led a couple of. So in this game, reputation is a big deal. And being able to play by the rules of the book is absolutely super, super, super important. Of course, we do ask questions in our DD processes around strategic fit. How much of this does it fit to kind of our core ecosystems and all of those things? And often enough, as part of the DD process, we'll actually sit with 3 or 4 or 5 of the business units to say, we think this is a great idea. What do you think? Yeah. We're not asking you to commit anything, but do you think that there's an opportunity here? But what we've been very, very clear on is we are part of Old Mutual. So we don't tolerate a lot of things, but we, at the same time, want to play by the rules of the book.
Do you
Because
have
it's
to
a
invest?
patient.
Do you have to invest in profitable businesses or cash flow positive businesses?
Now, this is early stage, Colin.
And how long are they willing your backers to actually sit through this? Because some of the top companies in the world, let's take Amazon. Amazon took about 20 odd years to become profitable. They had a little blip, I think, in year 19. How much
Yeah.
appetite have your backers got to allow you to go through that J curve over what could be 5 or 10 years to be an overnight success?
I think what we were clear on with our group as we were kind of talking about capital is think about this. Fortunately, we have made investments into other VC funds, shareholder. So this was not our first foray in investing in a fund. So step one was think about the money you're putting into NEXT176 as the other investments that you've made in other VC funds. So you're not going to be coming with a P&L and profit conversation 6 months down the line. Yeah, and asking about J-curve. It is a long-term play. But what we did is also to make sure that we do protect the income statement of the group as much as possible. The blips that come, especially with venture building and a venture studio. It's one thing when you have one startup that you're building and you own 100% that you consolidate that loses, say, 2 million rands. When you've got 5 or 10 and you're trying to scale, that 2 to 5 becomes 20 to 50. At a point in time, it's going to be a problem, especially in venture building. So how you work to kind of think about deconsolidation and how you work to make sure that, especially for venture building, where you own 100% initially of the ventures, you create the right level of risk separation between your core, the group, as well as those startups. Because they can, in kindergarten, in a way, we kind of walked in and said, you don't want to be taking kids that should be in kindergarten into the big building. So there's quite a lot we've done to kind of structure the platform such that it looks susceptible to those things. It's got the right level of freedom, but it's also having the conversations with the group around what to expect. We're not going to have an ROE conversation right now. But over the next 5, 10 years, these are the things that you should be expecting of us. So the first 5 years, we're still deploying capital.
How do you get the board and Exco on board with this? I know you say that they have some investments, but let's be honest. When I look at Africa, we have a lot of private equity, but venture capital and corporate venture capital is quite new and very isolated. If you're living in the US, the US has just got such a culture for risk. If you're in Silicon Valley, they've got 40 or 50 years of this cycle of failure, failure, success. Their whole portfolio is structured so that if you get 1 in 10 as a venture capital fund, you're doing probably better than the average. And obviously the top guys are consistently not necessarily backing more successful companies. It's just the few that they back, which really do pump, become the Amazons or the Googles of the world. And so they're used to it. And then, kind of this has become embedded in their culture. I don't think we have that here in Africa. So when you're going to someone, especially a corporate, and saying, we could see many of our investments just fail, actually go to the floor. we may be in scenarios where to make these things work, we have unexpected capital injections that we're going to have to make to sustain these entities. But we do believe, with limited evidence from history, because it's new, that if we do this over a period of 5, 10 years, we're going to start to see really, really good returns on the back. How do you paint that picture and get the guys to go and back into this?
Yeah, I mean, I think about it in kind of 4 or 5 things. I think firstly, Colin, if you can't get over the line with your C-suite and the board around the strategic importance of being able to have, growth coming from your core businesses, but growth coming from outside of your core businesses. That's step one. Yeah. The why should be important enough. Yeah. In our case, that was true. Our why around, we believe that by playing in the early stage, investing, VC type world, venture building, we can create a portfolio that creates strategic optionality for Old Mutual. Create strategic optionality. That's the first one. Secondly, we spoke about commitment on capital. It's not a 1 year, every year I go and talk about budget. No, it is in the same way that you deploy capital into a fund as an investment, you've got a committed capital that our team draws down on. Yeah. The third one is had to think about it with a portfolio thinking approach. Out of the 5 or 10, there's going to be winners and there's going to be losers. But if with it and every loser, you have to go to the board and explain why it lost, then you're going to fail and you're going to fail dismally. So we believe that actually think about this as a portfolio and making sure that your investor, in our case, who also is our owner, is able to actually understand that they've got to look at the overall portfolio rather than kind of thinking about each and every individual investments that we make. Of course, as we've constructed our portfolio, we thought very, very hard about issues around concentration and diversification to make sure that you're not trying to make one bet, and if that bet fails, the entire thing crumbles. And also, how do you govern the thing? How do you create the confidence, that of course you're doing the right DDs, of course you're doing the right processes, but you're doing them very, very quickly. I'm a firm believer that, good and quickly are not mutually exclusive. If you want to play by the rules of the game, you've got to do these things properly. There is a world that's out there that expects certain things to happen at a particular time. If you're not going to be able to do it at a particular time, it is important that you say it. Now, we've had instances where actually when we do our DD in a follow-on transaction, or when we're not leading that round, actually we find other things that, some of the other DD providers have not found. Actually, that has been useful to the startups. It's like, no, there's a tax issue here that you might have missed. So I think it's important that if you are going to be a little bit slower, you manage that expectation upfront. I think if you're not strategically aligned at the group, it's going to be a problem. If you're not thinking about investing in something like this as a fund, kind of commit capital upfront with the drawdowns. If you're not thinking about it as a portfolio where you've got the right level of concentration and risk diversification, and you've trained your investor to think about this as a portfolio, of course we've had failures. We have write-offs. But I don't have to go and explain what the write-offs are, because the overall portfolio for the stage that we're at is still appropriate. So those are some of the fundamentals that we've had to do, Colin, and we continuously do.
I know you travel a lot and you speak to a lot of people. You've got external advisors who've got global experience. When you were setting this up and planning out how you wanted to structure it, are there any kind of templates that you took from some of the well-known corporate venture capital companies overseas? For example, we've got Standard Chartered Ventures that some on the call may know, or you've got Google Ventures. You've got a lot of, the Fortune 500, I think probably 80% of the companies have got a corporate venture arm compared to whatever the low percentage is here. Did you have a specific template that you brought across?
I think we've learned most of those, Colin, if I'm honest. I think in the last 3 years specifically, we've been part of the global corporate venturing teams. And to your point, think about any CVC globally, whether it's Intel Capital is there, M12 for Microsoft is there. You think about TDK still exists, and they've got a venturing unit, Nokia, et cetera, et cetera, et cetera. So the ability to kind of work with the global corporate venturing team led by James Merson and his colleagues, but also to be able to work with a TDK Ventures, to be able to work with Standard Chartered Ventures, to be able to work with the guys coming from Intel Capital, has been absolutely amazing. And if anyone is going to start a journey like this, I would really, really, really say actually go and figure out how the best are doing it.
Mm. Did you have to go and make changes though? Because what they can do in say the US is going to be radically different to what we're able to do here in Africa or in South Africa, or is it pretty much copy paste of what you thought was the best when you went and sort of stole from them all?
I think it's more kind of a journey more than it is the difference. So an Intel Capital is 20 years old. Nokia Global Partners is 25 years old. They have $2 billion that they manage, you know. Uh, and when you listen to their journeys, some of them, you think they're very, very mature right now. They didn't get there overnight. So we're not set up as a fund. Next176, as an example, is a wholly owned subsidiary of Old Mutual. The underlying activities we do and how we do it, we try to, act as if we are, but we are not. So what you see just from a corporate structure perspective is many of them do start off as wholly owned subsidiaries. Then they get the parent to kind of agree to their fund as a single LP. Then they might get second or third LPs, et cetera, et cetera, et cetera, et cetera, et cetera. So there's a maturation, around some of these things. And what you need at a point in time also changes. And so kind of being able to see the journey that some of them have gone over time has been
Mm.
really, really amazing.
What do you think in the kind of summary of the benefits are? And where I'm going here, because the follow-on question is why do so many corporates not have corporate venturing arms? But firstly, what is it that Old Mutual really can gain from doing Next 176?
So when you were asking me about the size of the portfolio, in the first 3 years, we already have one of our portfolio companies spun into Old Mutual. That's strategic optionality. That's strategic optionality. Because we scan, we take the early bets, yeah. And actually, an Old Mutual has an opportunity to say, whoa, instead of kind of exiting this externally, actually, we will acquire this from you. That's amazing. It solves so many other things. Instead of you going out in the private equity market on your own, an Old Mutual now has an opportunity to observe the journey of 3 or 4 of these whilst they're still in our portfolio and has the opportunity, at a very, very arm's length to say, actually, we think that this is a great acquisition when it's ready. That's the key. That's really the key. From our perspective, we need to make sure that whilst we do that and make sure that actually we give the best financial returns to our investor. That's fundamental. If you think about that, there's quite a lot of studies that companies like McKinsey have done. They've called these things programmatic mergers and acquisitions. They show examples of companies like Slack who partner, invest, and acquire over time. Salesforce, I mean, who
Yeah.
partner, invest, and acquire over time. Slack is one of our Salesforce companies, by the way. If you think about where OpenAI is now from a Microsoft perspective, the role that M12 played much earlier on. You don't see it today, but it was there right at the beginning. So when you think about growth and you think about growth outside of your core, M&A and acquisition does play. What we do is to help de-risk the M&A world by creating that optionality. So that's really,
Mm.
really super important in kind of how we think about what we do, Colin.
So why do so few large corporates seem to go and set up distinct corporate venture arms? I'm not saying corporates don't innovate, and I'm not saying they don't invest. They do, but they tend to hold it within. They run it within their organizations. You've made that distinct decision to differentiate yourself from Old Mutual, to set your structure away, to protect yourself in many ways from the day-to-day operations that large corporates, go through. So you've got autonomy to take your own decisions. It feels like a really obvious thing to do. I really want more corporates to do that. We'll chat about why, in a minute, but they don't. What's your kind of take on that?
Colin, I think firstly, you have to be very, very clear about where you want to play. So if you're trying to innovate around your core businesses and you're trying to get incremental gains by improving this and getting efficiency, you don't need to set up a separate unit, in my own opinion. Your core businesses should be doing that. Yeah. But when you want to explore outside of your core, then you have to really think about the structure, because how you do measurement, how the incentives are aligned is very, very different. It's not, you're not going to put something in and you get a benefit in the next year or 2 or 3. It's a little bit of a longer game. So I think that separation is important, especially when you're playing in horizons outside of your core businesses. So I think that's the first one. I think the reason I enjoy these conversations, Colin, is not because it benefits Old Mutual per se or Next 176 per se, but what it does is it kind of creates credibility. It kind of says, actually, this can be done. I mean, we've only been in existence for just under 4 years, and I'm not saying that we've cracked everything in this space, but there's a lot of lessons we've learned. And I'm happy to share those lessons. Why? I believe that if the ecosystem has a lot more of these corporate venture-backed units, it's good for the entire African story, rather than just for while in Next 176.
Look, I think it's vital for the African story. I mean, something which is really eye-opening. I was doing a little bit of research pre the AWS summit coming up in a couple of weeks, and venture capital into Africa just seems to have dried up recently. I mean, it was already incredibly low. I mean, less than, let's call it $3 billion, right? I mean, that's 1/100th of the VC flows that are happening, globally. It's a tiny amount of money. And then when it's coming in, obviously, it's the demand is huge and that supply of cash is so limited. And then we've got the next problem that when we're looking, and why does that happen? Because when you're talking to the international investors, they're saying, we can't see an exit route. We can't see a way to list these companies at the moment. And therefore, if you've got no way to exit, you're not going to invest at Series D or Series. And so it trickles the whole way down. And who's going to put those initial investment and seed capital investments in? The group of people that have got immense power to go and influence and start to go and invest in startups are corporates, because we've got balance sheet. The top, I don't know, 50 corporates across Africa, hundreds of billions of dollars of balance sheet and cash available to invest into startups for all the benefits that you've seen. Do you think there's a movement that can be created, there's an education process that can be created to draw more interest into corporate venture capital? Because the benefits for economies just seem obvious when we look internationally, but it seems we need momentum. We've got to start pushing this somehow, that we build trust in it and we get execs and boards backing this across not just South Africa but the rest of the continent.
I think that's the opportunity. The challenge is, firstly, Colin, on the African continent with VC as an asset class, you've said them very, very well. But if you kind of look at VC as an asset class across the African continent, as a percentage of GDP, it's less than 1%. If you compare that, it's less than 0.1, in fact. If you compare that with kind of Southeast Asia, you compare that to India, you compare that to Europe, India is 0.35%, Europe is 0.28% already. That's just pure VC as an asset class. And then if you extend that further and say, actually, the biggest challenge that we have is not the amount that goes into seed, is the gap in that funnel, is the gap in the funnel pre the private equity. So yes, there's quite a lot that goes into seed. There's quite a lot that goes into grants and all those things, but there is a gap in the scaling and the growth. Yeah. Corporates have a massive part to play in that. All the things that you've said around exit opportunities, corporates, we firmly believe, have a massive part to play in filling some of those gaps. Not only because of capital, but also because of the skills and expertise that they can bring, especially in regulated industries. So you ask us about our unfair advantage, a conversation you and me have had before. In many of the companies that we've backed, I can't help them with great marketing. I can't help them with accounting. I mean, Old Mutual, we use those services. Yeah. If a startup is trying to find the best accountant, they must not come to me. But at the point at which the startup is starting to think about financial services, of course they must, because that's our superpower. We will not always get it right, but that's a unique thing that we have that is able to create a delta in the returns of the companies. So being able to also be clear about, of course, there is capital, but there is something that is unique to you that you bring as a superpower. And the reality is that the example I gave you before around our one first exit is that we're creating optionality in those exit pools. To your point, as an investor, you're putting in money, you want to know how you're going to get your money back. And so when we can create, many other corporates who actually can help fill some of the gaps that we have, especially in the kind of exits, we don't have a lot of IPOs on the continent. That's super, super amazing because now that funding is right globally, M&A has become really, really top class, and corporates have a big part to play in that.
Which are the sectors or the areas which are most interesting, for you, now? I mean, I think about how transformational technology has just been over the last year or two. It's unbelievable in terms of how that playing field is changing. Where are you most excited? Are you seeing these opportunities to disrupt and to do some quite incredible things?
Yeah, I think two themes, infrastructure broadly, uh, telco, etc., massive focus, all the work that goes into data centers and the funding of those is and is going to be even more important going forward. Our lens on it has always been our superpower. Our superpower is financial services. We think on the African continent, once again, the difference between inclusion, financial services and impact. It's very, very difficult to kind of extract those two. They're not mutually exclusive. If you think about where the African continent is and you kind of think about our GDP growth over the last kind of decade or so, the African continent has had a slightly higher GDP growth over the last continent than the rest of the global averages. But when you look at the split of those, you start realizing that actually we've got a massive, billion people, just under a billion people actually are living in severe poverty. So financial services has a massive part to play in actually societal upliftment. So anything that is actually thinking about financial services and societal impact and upliftment is super interesting for me.
Mm. Do you see this being the blockchain, or rather, blockchain will be the enabler for across Africa? You're not so keen on the technology. I mean, one of the problems with financial services is the barriers to entry are quite high, either in terms of technology you need to access, or because you've got to go through, KYC and other, application processes, which can be difficult in different parts of Africa. But at the moment, the key barrier is it's expensive to have a device. It's expensive to access the internet. Most of the financial service providers charge you a lot of money because they're expensive in terms of what they do. They don't differentiate themselves because, I don't know, I'm living in a township, but I'm still paying ABSA as an example for them to go and service the whole of the geographies that they work in with cash. So they're very expensive organizations that we have to actually fund. How are we going to go and disrupt these areas? Because we've been talking about that for decades, and I'm not sure we're making much progress.
Yeah. Colin, let me put it out. You know this, but I want to put it out there. Um, so, so my background is I started off as a young engineer. So mid-90s, we were learning about, I didn't have a cell phone, and I was doing a master's in 3G technologies in the mid-90s. I didn't have a cell phone, and we already think about data and 3G in the mid-90s. Mid-90s, AI was already a key part, whether it was facial recognition, speech recognition, text imaging, and all of those things. What we've seen over the last 2 or 3 decades is kind of the combination of the growth in actually the telco infrastructure. What we've seen is what cloud and cloud computing has brought on. So the things that in the mid-90s you couldn't do, and right now you can actually do, incredibly quickly and a lot cheaper than you could, So AI is a massive, massive part of that journey. It's so mature right now and continues to mature. And actually, it has to be a critical and integral part of all the things that we're doing. 10 years ago, when you wanted to build a website, it was expensive. In fact, when you wanted to build a mobile app, it was expensive. But you look at it right now and say, actually, on the African continent, how many people are actually on WhatsApp? So why do you need to build another mobile app?
Mm.
and you think about the power of AI and actually understanding that and being able and generative AI on top of that, so the power of technology, I take it as a given. It has to be a given. We have to be really thinking about the lowest common denominator. I was at Standard Bank in the late 2000s. We built USSD banking, 2008, 2009. Within the first year or so, those numbers, the active user base on that were like 2 million odd clients. Of course, you're riding on top of a scaler, but that was USSD banking in many of the markets that we've operated in. In Zimbabwe, we had a team that built the wallet business called Omari there. It's all on USSD. Within the first year of operation, in 11 months, they'd gotten their first million client. Now compare that to a CABS bank in Zimbabwe that has been there for more than 100 years, that has 800,000 retail clients.
Wow.
So the power of tech, the power of what we do on things like WhatsApp, what we're starting to see coming out from AI and is super, super transformative. It gives me belief in our ability to be able to reach and positively impact 1 billion lives.
If we're going to do that, obviously we need a lot of startups and guys to come through. It's kind of obvious, really. A few big institutions aren't going to go and solve all problems that we face as society and monetize that. Have you got any advice for startups? People, it could be just an idea. You could be halfway through 6 months burning cash trying to go and do your MVP and your proof of concepts. Okay, you're interested now in this corporate venturing. You've previously been looking outright venture capital, and you've been also looking at private equity. What advice would you give them to approach corporates? Firstly, should they? I mean, let's be honest. I know we say you should approach next one. Should they? That comes with baggage when you approach a corporate. They can be quite challenging beasts to deal with. And if you do want to go through that, what sort of steps should you take?
Yeah, I think I've seen so many horror stories, Colin, of startups being killed by corporates. Because for the young entrepreneur, the young startup, they look at the lure of kind of the massive distribution and all of those things. Yeah. But also kind of thinking about, is your organization ready to have that conversation? The processes that corporates work through, will kill you. Yeah. So doing your due diligence on the readiness of that startup, kind of further than just the lure of how big they are. How are they set up? What processes do they go through? Just from a pure procurement perspective, from a partnering perspective. If they've got a corporate unit, how does it work? Corporate venturing unit, how does it work? They never ask me, regrettably, they never ask me about the fund, the size of our capital. That's very, very important for them because, that startup knows that it's not about the first check. I'm going to have to write 2 or 3 checks, assuming that the startup is making progress. So it's not the first check, it's the ability to follow ons. But most of them don't ask. They should ask. They should ask about, your setup, how the autonomy you have or you don't have, how do your processes work? And Colin, as you as a founder, this is everything that you have in your life. You've put everything here. You want to make sure that the person giving you the check is also heavily invested in your success. They don't ask me how much my incentive is linked to the success of their business. They should. So I think being able to take a hard look at yourself and saying, am I ready for this conversation? But also when you think you're ready, asking the tough questions of the people. They ask you tough questions, you should be asking them tough questions too.
It's such good advice, that.
To determine whether you actually want to take their money.
Yeah. No, I mean, it's such good advice. I mean, you see it throughout in so many examples. Employees, potential employees, happy to get the first job, take anything, not asking those questions about the culture that they're going into and doing the research. And there are so many startups. I mean, just being a supplier into a corporate brings, baggage. Asking yourself whether you want to go through the inordinate amounts of paperwork so that you can be onboarded and start that relationship and then all the issues that come with it, versus I could have 20 small medium enterprises clients with a lot less hassle, nicer relationships, and potentially they're going to pay on time a lot more. I mean, that's so important.
Absolutely. And actually, it's much easier to work with. They might not have the scale, but at least you use that as a way of learning how to actually work with clients. The last thing you want is an old mutual as your first big client when you've never had anyone else. If it
Just a
works,
question.
great, but there's a likelihood that it doesn't, and your business is dead.
Slight detour on this question. Maybe I should have covered it earlier, but I'm also keen. I don't know if you know the answer. Interested in your views on venture studio models, ShopRiteX, Naspers, and Porcupine Union. Thanks a lot.
Yeah, so maybe a step back. So remember I said we partner, we build, and we invest. And when I talk about our portfolio, I said we've got 17, 18 businesses, excluding the recent exit. In fact, the recent exit came out of a venture studio. So we do that. The point that I was making earlier around, when you're making small equity investments under 10%, 15, 20% or so, it's not such a big deal in terms of kind of financial accounting and treatment of those and control. But a venture studio, remember, this is your idea, it's your capital, it might be your employees, so you own that 100%, day zero. Yeah. And so how you think about governance, risk, and all of those things is the most important thing. So we think venture building and venture studios are a critical part of our ecosystem, done right. Okay? We think the opportunity to be able to de-risk the failures and actually the learnings from. I sit with many different entrepreneurs trying to build inside a corporate, but you are alone trying to build a venture inside a corporate. We've got 10 trying to build inside a corporate at any given point in time. And just the opportunity to be able to leverage the cross learnings across all of those. But when you're doing it on your own inside a big corporate, it's very, very lonely. You don't have anyone to talk to about this and that, and how do you structure this, how do you do that? So we've created that portfolio. We've created a portfolio at any given point in time. We have around 5 or 6 that are pre-carve out, meaning we still own it 100%. We haven't gotten external investors. We haven't created equity pools for the founders at any given point in time. And we continuously look, as they make traction to kind of think about, can we get co-investors to diversify our risk? Can we give the right incentives to the founders to make sure that they have proper skin in the game? And did the person who started, is that person the right one to be able to take it to the next level?
Let's flip it from what startups should be looking for. I'm an employee in a large corporate, let's middle senior management, perhaps senior management, not exco board level. I've watched this. I'm super excited. I do a bit more research. I see NEXT176 and other venture capital. I realize when I look overseas that they are fundamental. I see examples. Waymo's another example. Obviously, that came through X in the Google stable. That's going to be a phenomenal sort of business. So we realize we need to do something in corporate venturing. How do I get this up and running? What would be the steps that I should take?
You get it up and running with great difficulty. So I've kind of said in my playbook, Colin, there's probably 5 things to think about and think about very, very deliberately. Is it strategically important to your division or your organization? And I say division, if you kind of think about many of the South African corporates, a division inside a big bank or big telco or even a big insurer is massive. So it doesn't have to be at the group level, but is it important, for that sponsor? And is it actually talking to the core strategy of that organization? That's the first one. I talk about it and say, actually, think about commitment on capital. It's not about the first idea that you do. It's about the journey of all the things you are going to do. So get that commitment upfront. Because if you don't, you're going to create all of these things that are going to be orphans. It's a problem. Yeah. You've got to make sure that you understand, but whoever is giving you the capital understands that it's a portfolio. It's not just about that one. it's about the portfolio of bets that you're making. You are going to have winners and losers. Yeah, but it's really about thinking about it at a portfolio level. Make sure that you think about governance. You're given money, it's shareholders' money, it's inside a big corporate. What is the appropriate governance that you want to have? Governance that ticks some of the boxes that the corporate has as an investor and an owner, but also make sure that in the ecosystem that you're playing in, you are playing by the right books. And just think deliberately about how you structure the incentives that you have versus the incentives of the startups and versus the incentives of the big corporate. How do we make sure that the incentives of all the people along that chain are aligned? Those are probably the 5 key ones for me. And actually, I can double click on any of them and we can spend an hour talking about each of those.
Number 6, you need to have a fairly significant personal risk appetite, because when you embark on these types of journeys, which are novel and new, those antibodies are going to push back.
It's linked to number 5, incentives.
All right, last 2 questions. I think Nadim's come in just at the right time with this question. I'm glad someone asked this. What steps do we need to take to connect with NEXT176 to present the pitch deck and to partner with you guys?
Yeah. LinkedIn, by all means, directly to NEXT176, directly to me. I really try deliberately to respond. So please reach out and happy to talk.
And then if you place yourself, I don't know, conference, you've got the opportunity to talk to 100, 150 of the top CEOs across Africa. You've got 60 seconds or so. What's your message to them? What would you want to get them to hear about corporate venturing?
Yeah, I think, Colin, for me, the top one is that as an option, as you think about your growth portfolio, as you think about your organization, as you think about your growth portfolio, what do you get out of your core businesses, but what do you get out of your, outside of your core to create strategic optionality? The models do exist. There are successes that are out there, the M12s of this world, great successes, the Intel Capitals, great successes. If you think about what TDK is today and what it was 20 or 30 years back, it's because of entities like TDK Ventures who are continuously trying to think about how to reinvent the future. But that CEO also has to ask those 5 questions. How important is this to me? Am I willing to allocate capital? Am I willing to approach this as a portfolio? Am I willing to work hard with the team that is setting this up on the right process and the governance? And I'm willing to actually work very, very hard as a sponsor and a CEO to make sure that I align the incentives of the unit, the individuals, with the startup.
Well, thank you very, very much. Thanks to everyone that's joined. We've run out of time. Big thanks to our sponsors. So thank you very much to AWS. Thank you to Silicon Overdrive. Without them, we wouldn't be able to do these events. Also, thanks to everyone that's helped with the marketing on this, Gem HR, a couple of the other guys that are sitting there, part of the NEXT176 Ventures array. More details about the guys that have helped us there on the website. I'll put the link on the email that comes on the back of this so you can have a look at those. Bento's another one. Coming up next, it's going to be Ozo with the new acting CEO, Rachel Cowan. We'll be learning about her journey, moving from COO to CEO, what the goals are for the next couple of years, how they see the whole payments industry transforming. So we'll send out details on that if you want to go and join. And then there's a set of other interviews I'm keeping secret at the moment. We're just getting them in the works and getting them agreed. So we hope that some of you guys would join that and find it interesting. Anyway, to close, most importantly, I want to thank Vuyo. Thank you for your time. I really do appreciate it. Thank you for sharing your wisdom. And of course, to everybody that's just joined us on the call, I appreciate you taking the time. I hope you got value of it. And whatever you think, whether you did or you didn't, I'm sure you're going to give us some feedback. Either way, I certainly look forward to that. With that, thank you very much, everyone. Have a great afternoon.